Hello everyone, my name's Harry Thompson and I'll be walking you through today's MPS report for Q4 2025. Global stocks had a slightly more subdued last quarter of 2025, albeit largely positive, with the notable exception being weakness in Chinese equities. The year was marked with a number of geopolitical events, but there was a risk-on mood with equities posting strong gains, notably in the UK, Europe and emerging markets, as investors broadened their allocations away from the US. Risk assets have also been buoyed by interest rate cuts from major central banks, such as the UK and the US, although heading into 2026 the path of monetary policy is less certain given economies remain relatively robust. UK equities were notably strong once more in the fourth quarter, leaving the main index at record highs. Whilst the returns of the non-screen index have largely been driven by 5 banks and 3 defence companies, which form smaller or no part of sustainable portfolios, the SRI screen version has kept pace in Q4. UK equities in general remain at historically low valuations, so opportunities still remain heading into 2026, including the added benefit of diversification. Fixed income was positive in the quarter, with sterling assets benefiting from the Bank of England's rate cut and a budget that was well received from the market after months of speculation. The UK 10-year gilt yield fell by 0.22%. In commodities, copper's rally accelerated in the quarter, with the largest annual price rise in over a decade. Fears of global shortages has fueled a frantic rally in recent months, as demand continues to grow for the build-out of renewables, electric vehicles and data centres. Similarly, gold and silver have had record years as investors moved into haven assets amidst geopolitical tensions, alongside selling US dollar currency and treasuries in favour of precious metals. And now for a review of the ethical MPS. With growth equities lagging in the quarter, Janus Henderson Global Sustainable Fund and Hermes Sustainable Global Equity both detracted from performance. Schroders Global Sustainable Value Equity was a notable positive contributor, returning 5.81%, a holding we added to at October's rebalance. With UK large cap equities continuing their strong run, Janus Henderson UK Responsible Income returned 4.7%, whilst the portfolio's UK growth equities lagged, albeit still positive on the quarter. Despite a notably weak December, healthcare continued its recovery, with Polar Capital Healthcare Opportunities returning over 7% in Q4, putting its 2025 return in line with global equities. Portfolio's emerging market exposure outperformed developed markets, with UBAM Positive Impact EM returning 6.23%, whilst the new addition of Aberdeen Emerging Markets added over 3% since its inclusion in October's rebalance, which was almost 8% on the quarter. Outside of equities, fixed income was a positive contributor, with longer dated fixed income outperforming shorter dated, while sterling-based assets outperformed global. UK renewable infrastructure was weak in the quarter, given the heightened policy uncertainty, with an amendment to the pricing mechanism the latest blow to the sector. Portfolios had seen a reduction in their UK exposure, with a greater focus on global infrastructure. Nonetheless, the asset class detracted from performance, with the RM Alternative Income Fund returning minus 1.62%. And now moving on to the Brighter World review. The core equity allocation was largely a positive contributor to performance, with the UK SRI allocation once again notably strong, returning over 6%. Other regions were more modest, with the Japan SRI and Europe SRI returning 2.16 and 1.65 respectively. On the flip side of this, the USA SRI allocation, where we remain underweight against the geographical weight of major indices, was just negative, placing it largely flat for the full year. After a strong third quarter, the X-Trackers Global SDG ETF, which targets equities focused on sustainable development, returned just over 1.3%. The satellite thematic allocation has been more mixed in the quarter. The Van Eek Semiconductor ETF was sold at the October rebalance for a gain of 9.22% in the quarter. This was replaced with the WisdomTree Cybersecurity ETF after some weakness, although this has seen some further weakness since introduced into the portfolios. Healthcare continued its recovery despite a weak December, with the X-Trackers MSCI World Healthcare ETF returning over 10%, Water and waste themes lagged, with LNG Clean Water returning negative 1.8, whilst the slightly more value-focused Rise Environmental 100 added 1.57%. Outside of equities, fixed income was a positive contributor, with longer-dated fixed income outperforming shorter-dated, with the gilts the notable performer post-budget. Portfolio's property exposure returned negative 0.14% after a strong Q3. And now looking at an overall asset allocation view. Portfolios were rebalanced in October. Fixed income exposure was reduced, notably reducing or selling lower risk portfolios' gilt exposure. This was completed in order to take a more cautious approach into the UK budget. While sentiment had improved with regards to the outcome of this risk event, we felt it was prudent to lower exposure. Portfolios remain above neutral for this asset class, and we maintain duration around the 4 to 5 year level across portfolios. We've increased equity exposure to around 3 to 4% above the neutral position. However, where we have added to equity, we've increased into more defensive or value equities. We've trimmed back those funds that had a particularly strong last 6 months, including healthcare, as well as those funds buoyed by AI-related enthusiasm. Now turning to the outlook. Amid growing talk of an AI bubble, investors are questioning whether AI and large technology stocks can continue driving equity markets higher. Valuations remain elevated and earnings are under increasing scrutiny, leading to volatility when expectations are missed. However, earnings growth is still positive and AI remains a long-term theme. In 2025, policy uncertainty under the Trump administration prompted investors to divert away from the US, weighing on the dollar and treasuries. As a result, equities returns broadened, a trend we expect to continue. This has supported portfolios underweight to the US and benefited emerging markets, helped by favourable macro conditions and a recovery in China as trade tensions ease. Broader market participation has also supported previously underperforming sustainable themes. Clean energy has rebounded on the back of clearer policy support, rising AI-driven energy demand and falling interest rates. Lower costs of capital are improving prospects across several future-focused sustainability sectors, despite ongoing political noise. Central banks remain in focus as economic signals diverge. The UK economy is weakening, with inflation limiting the Bank of England's scope for aggressive cuts, though around 2 cuts are still expected in the year ahead. Europe appears more resilient due to fiscal support, and we expect the ECB to remain on hold as a result. The US outlook is less clear, with changes expected at the Federal Reserve in May, and incomplete data due to the government shutdown. While softer inflation and labour markets could justify rate cuts, we expect the Fed to remain on hold in the near term. With mid-term elections approaching and inflation still a key voter concern, monetary policy decisions remain politically sensitive. And now moving on to this quarter's case study, which is SSE, held in model portfolios through equity and fixed income. SSE is a UK-listed energy company operating across the UK and Ireland, and is a leader in the transition to clean energy. It has shifted away from fossil fuels to focus on renewable generation and electricity networks, becoming the UK's largest renewable energy provider. Key projects include Dogger Bank, the world's largest offshore wind farm, capable of powering up to 6 million homes. SSE has a long history in hydroelectric power, with assets dating back to 1951. Both hydro and offshore wind require strong biodiversity management, and SSE are supported by fisheries biologists who help ensure legal compliance and minimise environmental impact. In the quarter, in November, SSE announced their £33 billion 2030 investment plan, centred on upgrading the UK's electricity system to support electrification, energy security, and the transition to clean power. Later in the quarter, they announced their largest housing deal with Springfield Properties to deliver nearly 300 homes across northern Scotland. By addressing local housing shortages, the project supports grid upgrades needed to connect renewable energy and improve energy security, with homes initially housing workers before being available to local communities. Thank you for listening to this Q4 update. A text version is available online, and as always, if you have any questions, please contact us.